So this is the second class for consolidated financial statement, date of acquisition. So today we are going to see more details about the consolidated balance sheet. And I would like to review some concept. So we are here, consolidated balance sheet using works paper. And don't forget that we are talking about consolidated balance sheet, the date of acquisition. So what is the assumption here? Assets and liabilities are assumed regardless whether the parents own 100% or a smaller of the controlling interest. So this is important assumption. Parents company acquired 100% of S. So we have to consolidate 100% of S company's asset and 100% of S company's liability. Even P company acquired 70% of S. So how to consolidate? We should consolidate 100% of S company's asset and 100% of S company's liability. And the remaining 30% will be considered as non-controlling interest. In short, we can say NCI in P company's equity account. So this is very, very important assumption. Whether you acquired 100% or less than 100%, you have to consolidate 100% of asset and 100% of liability from the subsidiary company. And remaining, if you acquired less than 100%, remaining should be considered as non-controlling interest, and we should report it under the equity section of parent company. So we should do some elimination entries when we do the consolidation. So we have to eliminate or close investment in S company, because parents company record investment in S company. We have to close it. We have to close it against the equity accounts of subsidiary company. So we have to close. Right? We have to close investment in S company and investment and equity of S company. So these two accounts should be closed. Why we need to close this? Because when we consolidate balance sheet, we acquired 100% asset of subsidiary company and 100% liability of subsidiary company. So asset minus liability is equal equity. Okay, assets minus liability equal equity. So if you record asset, if you record liability, again if you record equity, it is called double counting, because in between it is equal. So you record their asset, you record their liability. So you don't need to record their equity. So investment in S company, we already record debit, so we have to close it. So anyway, so we don't need to record equity again, so we have to close it. Okay, and as we already record assets and liabilities, okay, we don't need to record net asset, so we have to close it. So here net asset means investment in subsidiary company. Here net asset means investment in subsidiary company, and we are going to close equity of subsidiary company. That means we are going to close common stock plus additional paid in capital plus retained earnings. So these accounts are going to close. So equity means common stock, additional paid in capital, and retained earnings. So we have to close this three account. We have to close this three account, and we have to close the investment in subsidiary account. And how to close it? I told you that the normal balance of these three accounts are credit. Normal balance of common stock is credit, normal balance of additional paid in capital credit, and normal balance of retained earnings credit. To close, we have to record in the debit side. And the normal balance of investment is debit. To close, make it credit. So these are the closing entries. These are the closing entries for elimination entries for subsidiary equity and the investment in S company. What we are going to keep? I told that we are going to keep asset and we are going to keep the liabilities for both companies. So after closing this, we will have asset, parents company and subsidiary company. We will have liability, parents company and subsidiary company. So as we already record asset and liability, we don't need to record net asset and equity because the formula is here. Asset minus liability is equity, or asset minus liability equal net asset. So we close net asset and we close equity, and we only keep assets and liability. And as we are going to talk about the consolidated balance sheet, so we are going to talk about consolidated balance sheet. And you know that these are the elements of balance sheet. Balance sheet should have asset, balance sheet should have liability, and balance sheet should have equity. So these are the three sections. These are the three sections for a balance sheet, right? Asset, liability, and equity. So when we insert asset, it should be both parents company's asset and subsidiary company asset, parents company's liability and subsidiary company's liability. Okay. Then we don't need to record subsidiary company equity, right? Why we no need to record subsidiary company equity? Because asset minus liability already equity, right? So we don't need to record subsidiary company's equity. So which equity you have to record? We have to record only parents company's equity. So you have to record only parents company's equity. Clear? And if we have any non-controlling interest like NCI, non-controlling interest, we have to record it under the equity of parents company. So these are the elements of consolidated balance sheet equation: assets, liabilities, and equity. Which asset? Parents and subsidiaries asset. Which liabilities? Parents and subsidiaries liabilities. And P equity only. And if we have any non-controlling interest, we have to record here. So this is from the previous class. So why we need this kind of elimination? Why we need eliminations? To avoid double counting of net assets. To avoid the double counting of net asset, we have to do this kind of elimination here. If we record asset, if we record liability, again we record net asset, it means that it is double counting, right? So in order to avoid this kind of double counting, so we are going to eliminate the net asset. Then when parents share of subsidiary company's equity is eliminated against the investment account subsidiary anyway. So this is the same things. Now to solve this kind of consolidated balance sheet, because our title, we're going to, this chapter is mainly about, this chapter is about consolidated balance sheet. Consolidated balance sheet. Date of acquisition. To do so, if your question asks you to prepare the consolidated balance sheet at the date of acquisition using the work paper, Okay, using the work paper. So we are going to use using the work paper. So using the working paper, okay, we are going to prepare the consolidated balance sheet when it is at the date of acquisition. So we have another consolidated balance sheet after the acquisition. It is chapter 4. Chapter 4 will learn same consolidated balance sheet after acquisition. But here at this moment, we are talking about consolidated balance sheet at the date of acquisition. At the date of acquisition using work paper. Using work paper. So to do so, we have to go through several steps. First, we have to calculate the difference. We have to calculate the difference between implied value and the book value. So this is the workings you should do. What is the meaning of implied value? You know that implied value means fair market value. Fair market value. So we are going to compare fair market value and the book value, and we are going to see whether there is any difference or not. If there is any difference, okay, we have to allocate this difference in some places. But it is very important that if there is no difference, you are lucky. But if there is any difference, between implied value and book value, we have to allocate them, either asset or liability. I'm going to show you first how to do that, how to find out we have any difference or not. Step 1, determine the percentage of stock acquired. So I told you that you may acquire 100%, you may acquire 100%, or you may acquire less than 100%, like 70%, for example. So you have to read the question carefully and you have to find out whether you acquired 100% or less than 100%. Very, very important to find out this information. Because if it is less than 100%, then we will have NCI. Can you remember this NCI, non-controlling interest? So to establish non-controlling interest, we have to find out we acquired 100% or 70%. So this is important. Read the question, find the number. Then determine the purchase price. Okay, what is the meaning of purchase price? That means fair market value or cost price. That means the price you paid. The price, cost price, parent company paid to acquire S company. So you have to find out this information. Purchase price. So you have to find out the cost price, okay, that parent company paid to acquire subsidiary company. Then when you have this information, we have to divide this number. We have to divide this number by the percentage we already know. By the percentage we already know. So don't worry, this is something like this. For example, you subsidiary company. So you give me, for example, you give me $150,000. You give me this money. Sorry, you give me, yes, I told you that. I told you that if you so at this moment, no need to talk about subsidiary or parents. If you give me $100,000, I will give you, for example, 70% of ownership. If you give me $150,000, I will give you 70% of the ownership. So if this is the case, based on this information, you have to calculate what is the fair market value, or what is the fair market value or implied value of my company. So based on this information, you can easily calculate, you can easily calculate what is the fair market value or what is the implied value, of my company. Is it possible? So you give me 150, I give you 70%. So what is the 100%? So fair market value means what is the 100%? Okay, what is the 100% value of my company? So by applying this formula, we are going to calculate the implied value. Okay, so when you have the implied value, this is the step 2. So how to calculate the implied value? You can see that divide. So the formula is 150,000 divided by 70%. By 70%. The amount here is the implied value, equal implied value. So you have to calculate the implied value. And to calculate the implied value, we must know this number. Without how much percentage we acquired, without this number, we cannot calculate the implied value. To do so, we also need how much we paid. So this is the purchase price. Then in the step 3, we are going to compare. Implied value versus book value. This is step 3. Difference between step 2. Step 2 means we calculate here implied value. In the step 2, we calculate the implied value, right? Step 2, we calculate the implied value, and question will give you the book value. So book value is given in the question. So book value is given in the question. This part is given in the question. We calculate implied value. And to calculate the implied value, we need this information. Then we are going to compare. Implied value and the book value to determine difference. So this is about step 3. So I repeat again, we are going to solve consolidated balance sheet at the date of acquisition using the working paper. And from the very beginning, we have to have whether there is any difference between implied value and the book value of the company. If there is any difference, we have to allocate this difference. Okay, either assets or liabilities of subsidiary company based on the question. Question will tell you where you are going to adjust this difference. We can allocate this difference to any asset of subsidiary company, or we can allocate this difference any liabilities with the subsidiary company. So the question will tell you this information. So do you have any question from here? How to calculate the implied value? To calculate the implied value, we should know how much percentage we acquired and what is the cash or common stock we sacrifice to buy the subsidiary company. Then the formula is, this is the cash paid or sacrifice, divided by the percentage. And we calculate the implied value of our subsidiary companies. Then question give us book value, we compare it to find the difference. Now you can see that we may have for the difference, if we want to know difference, we may have three cases. We may have three cases to determine the difference. Case one, think. We are going to compare implied value and book value. So the case one may be something like this. There is no difference. Implied value means the market price and the book value is the similar. So in this case, there is no difference, right? Or we may have case two, something like implied value is greater than the book value. This is another possible case. We may have another possible case. Implied value is lower than the book value. Okay, so in order to determine the difference, we may have these three. Cases. And for every cases, you can see that for each cases, we may have these options: acquire 100% of S company, or acquire less than 100% of S company. So this is the things you should consider. So first, we are going to determine the difference, whether there is any difference between implied value or book value. So we may have three cases. Implied value equal book value. There is no difference here. Otherwise, we may have implied value is greater than the book value, or implied value is lower than the book value. And both cases, each cases, you can see that we may have either we acquire 100%, either we acquire less than 100%. So if it is less than 100%, we have to establish non-controlling interest. If you acquire less than 100%, can you remember, even it is less than 100%, you are going to consolidate 100% of asset and 100% of liability, right? Even it is less than 100%, you also consolidate 100% of asset and liability. So to do so, we have to establish non-controlling interest. Now we can see here case one. Case one said that, based on my explanation here, when we are going to consolidate balance sheet, we may have several cases. The first cases, look at this one. Implied value equal book value, right? Implied value equal book value. What is the meaning? Meaning is no difference. We do not have any difference. So if you don't have any difference, the question is very easy. Okay, if there is no difference, question is easy. But if you find any difference, you have to adjust and allocate. So according to this case one, implied value and book value similar, there is no difference, but we may have two alternative options like this. We may acquire 100% or we may acquire less than 100%. So 100% and less than 100% is similar for every cases, right? For every cases. Look at case 2. Implied value is higher. Implied value is higher and book value is the lower. Book value is the lower. So there is a difference. There is a difference. There is a difference. And here I repeat again, if it is less than 100%, don't forget to establish NCI. Okay, if it is less than 100%, don't forget to establish NCI. So here, implied value is higher, book value is lower, there is a difference. There is a difference. And as there is a difference, we have to, so if difference, we have to allocate and adjust this difference. And the question will tell you where should we are going to allocate and adjust. Maybe in the asset of S company. That means asset or liability. Asset or liability of S company. So to do so, you have to read the question carefully, where we are going to adjust and allocate the difference. We may allocate this under asset or under liability. Do you understand? So this is important to allocate and adjust the difference. Allocate and adjust difference is important. Anyway, so implied value is higher, book value is lower. We may have 100% acquired subsidiary or less than 100%. If it is less than 100%, don't forget to establish NCI. Do you understand? If it is less than 100%, you must do some calculation for NCI. I will tell you how to do that very soon. Now another situation. Now implied value is lower, book value is higher. Again, there is a difference. Again, there is a difference. Okay, so this difference should be allocated and adjust either assets or liabilities of S company based on the question. And we may have 100% or we have less than 100%, we have to establish this NCI. So this is the information I put here as a summary. Okay, this is the summary. Now, don't worry, when we will solve one question, you will find it more easy. So this is the title I put here, but your question may not have this title. You have to read the question. This is your question. This is your question. By reading the question, you should know, you should realize, or you should calculate whether you acquire 100% or not. Okay, whether book value and implied value similar or not. So this information is not going to be given as a title. You read this question, and you try to find out whether it is happen or not. Like here, look at this question. This question did not tell you acquire 100%. No percentage is mentioned here. There is no percentage mentioned, right? Is there any percentage mentioned? No. But by reading this paragraph, how can you make sure that? How can you make sure that you purchase 100% or less than 100%? Read this paragraph and try to understand. How can you understand? No percentage is mentioned, but how is it possible to find out? Assume that on January 1st, 2003, P company acquired all the outstanding stock of S company. If you stop here, What is the meaning of all? Yes, all means 100%, right? So although the question don't give you this information, but you have to understand. So the parent company acquired 100%. 100% of subsidiary company. And how much cash paid? The cash paid $160,000, right? So if I ask you up to here, can you calculate implied value? What is the implied value of this company? You paid $160,000 and you received 100% of their ownership, right? So what is the implied value? So it is, the formula is you paid $160,000, right? Divided by 100%, equal also same, right? $160,000. So this information you can use to calculate the implied value. This information you can use to calculate the implied value. Because if you remember the 3 steps here, if you remember these 3 steps, step 2 asks you to calculate implied value, right? Step 2 asks you to calculate the implied value. And to calculate the implied value, you need percentage. You need percentage and you need the purchase price, right? You need the purchase price and you need the percentage to calculate the implied value. So we already calculate implied value from here. So although this part do not ask you to calculate the implied value, so this is for your reference. Do you understand? This is just your reference, but this question do not ask you to calculate the implied value. The question said that you buy all the shares, you pay $160,000 cash. What is the journal entry? And you know what is the journal entry? Investment in S company debit. So this is your investment. So you invest $160,000. You invest $160,000 to acquire subsidiary company, and here question said that you paid cash. Maybe your question, another question said that you issue common stock. If you issue common stock, then common stock credit, right? So this question said that you acquire 100% of subsidiary company and you paid cash. It is given, and this is the narration. You know that to record. Is investment in subsidiary company. This is the parent's company's investment. If you are the parent's company, this is your investment. Now I keep this blank here to show you how to handle the 3 steps. So these 3 steps, because we have to find out, this is very, very important to find out the differences. Okay, it is very, very important to find out whether we have any difference or not. So to find out whether we have any difference or not, we have to go through these 3 steps. Because step 3 said that when you come to the step 3, we need to calculate the difference, right? So these 3 steps I am going to show you right side of the question. So this is the question. Your question is up to here. What is the question? Question said that the balance sheet of both companies, immediately after the acquisition. Immediately after the acquisition means just at the time of acquisition, right? Immediately means at the time of acquisition. So at the time of acquisition, this is the parent's company's asset, liability, and equity, and this is the subsidiaries company's assets, liability, and equity. So you are given this information. So based on this information and based on the first part of the question, we are going to see whether there is any difference between implied value and book value. Now, we know that according to this question, this is our investment, right? According to this question, $160,000. $160,000 is our investment. So it is here. Investment in subsidiary company, $160,000, right? So this is the price we paid. Price paid $160,000. So here, go to the step 2. Step 2 said that we have to determine how much price we paid, right? How much price we paid, divide by, we need one information from step 1, percentage, right? Percentage. So we need how much price we paid, and we need what is our percentage to acquire. So from this question we find that we paid $160,000. Company paid $160,000, and this is our investment. As we acquire 100%, this is our investment. Our investment is $160,000, and percentage acquired. How much percentage we acquired? 100%. Okay. So based on these two information, we have to calculate implied value. That I already explained here. So this is the price paid divided by percentage acquired equal the implied value, right? Equal the implied value. So we know what is the implied value or market price of this company. So this is the market price of subsidiary company, $160,000. Do you understand? This is the market price of subsidiary company. You give me $160,000, I give you 100% ownership, right? So this is the market implied value of the subsidiary company. Now, based on this column is about subsidiary company. This column is about subsidiary company. From this column, can you find out what is the book value? What is the book value of subsidiary company? Because we have to compare. We have to compare implied value and book value. We already have implied value here. We already have the implied value. We already have the implied value. So we should have a book value, right? And which book value? So this is the implied value of subsidiary. And we should have a book value of subsidiary from this column. Which accounts are called book value according to this example? According to this example, this equity at the book value. These three accounts. This is the common stock, right? Because you acquire 100%, 10,000 shares of the subsidiary company. So the book value belongs to here. Book value belongs to here. So here we don't have any other information for the book value. So how to calculate the book value here? Book value is the common stock, other contributed capital, and retained earnings. So if your question don't have these three, for example, your question don't have these three, how to calculate the book value? Very good, yes. Asset minus liability is the book value, right? We learned from chapter 2. Anyway, very good. So although as this question is given the book value, so 120 and 40, the book value is, if we add these three together, book value is $160,000. So we calculate the book value, right? We calculate the book value. We calculate the implied value. Now we are going to see the difference. Case 1. Case 1. We find that case 1 is book value and implied value similar, right? Similar, no difference. And we acquired 100%. This is case 1. We acquired 100%. Look at here. We acquired 100%, and book value and implied value similar. So this question is about implied value equal book value, right? And we acquire 100%. And this is our case 1A. Case 1A. This is case 1A. And you can see the title here. This is a short title. Book value equal implied value, and we acquire 100%, right? So here, difference is 0. If difference is 0, it means that the question is very easy. Okay, the question is very easy. We do not have any non-controlling interest. But your question may not be easy like this. Okay, so but to see another situation, we should know first if there is no difference, how to handle this. Now, this is the workings. The question may not ask you to do that. This part is just for your reference. In the question, I may not ask you to calculate the difference. You have to do this kind of calculation for your own benefit. Now, this is the question. Question said that the work paper to consolidate the balance sheet for P and S on June 1st, 2023, the date of acquisition. So, what is the consolidated balance sheet? What is the consolidated balance sheet? We are going to prepare when? The date of acquisition. The date of acquisition. I repeat again, we have another chapter. We also going to learn consolidated balance sheet after the acquisition, maybe 1 year later, how we can handle. But this balance sheet is at the date of acquisition. And the question, maybe I will give you up to here. And you have to solve this part, because this is given in the question, you know that. The question, this is from here. This is from here, right? This is from here. So this part is given in the question. This part is given in the question. And first we should do the elimination. Okay. And the previous class, last class, I also explained how to do this kind of elimination. Today I'm going to show you again. So my suggestion, if you want to solve it 100% accurate for chapter 3 or chapter 4, okay, if you want to do 100% accurate, so you have to do some journal entry first. The journal entry I explained before here. So we have to do this kind of journal entries first. So this kind of journal entry will help you to solve the question, this part accurately. Because we know that we have to close investment in subsidiary, right? We have to close investment in subsidiary, we have to close this account. And why we have to close it, I already explained. If you cannot remember, go back to my previous class. So here investment in subsidiary is given $160,000, we close it. We close investment in subsidiary. Then we have to close common stock, we have to close additional paid-in capital of subsidiary, we have to close the return. So these three accounts we have to close. And you know that normal balance of these three accounts is credit, to close, make it debit. So you can see we close common stock, we close additional paid-in capital of subsidiary, we close retained earnings. Why we close these three? Because we will keep their asset, we will keep their liability, right? Can you remember? We will keep their asset, we will keep their liability. So we close their equity account, and we also close our investment, because we are going to merge consolidate asset and liability together. So these things you can see that to close these three now based on this journal entry. And here this question is easy. Why this question is easy? Because we don't have anyway, we don't have any difference. If we have any difference, okay, if we have any difference, we have to record the difference. Difference may be debit or credit, you know that. If we have any difference, The difference may be debit or difference may be credit. When debit, when credit, it depends on implied value higher or lower. And if we have any difference, we have to allocate the difference. So look at here. So we have to calculate difference. Maybe another question. Another question, we may have difference. Then if we have difference, then we have to allocate the difference. So these two things we will do later on. But up to here, our first question is up to here. Our first question is up to here. We don't have any difference, okay? We don't have any difference and we no need to allocate the difference. So I delete this again. I delete this. Now we are going to put these three items in the debit side. You can see that this is the elimination column. This is the elimination column we put in the debit side. It is closed. We put investment in subsidiary in the credit side. We put its investment in subsidiary in the credit side. So based on this journal entry, this is the elimination journal entry. Based on this journal entry, we close subsidiary company's equity and we close our investment. If we do not close them, it means that we record double times. Now after closing this, so what is the asset? So this asset is now, you can see that it is $80,000. $80,000, and this is P plus S. Right? This is P plus S. That means parents company's asset and subsidiary company's cash. Then here this is $380,000. Then it is $320,000. This is $120,000. This is now zero. We have total asset $900,000. Then this is the liability. Liability $220,000. $220,000. So we are going to record parents company's asset and subsidiary company's asset, parents company's liability and subsidiary company's liability. And this is the total asset of parents company and subsidiary company. And this is the total liability of parents company and subsidiary company. So I told you that under the balance sheet. So this is the balance sheet. You know that balance sheet have three columns: asset equal liability plus equity, right? So this asset is the parents company's and subsidiary company's asset. This liability is the parents company's and subsidiary company's liability. So we close net asset, right? We close the net asset. This is the net asset. This is the net asset we close. Now we have remaining equity. Who is equity? We should have this three equity. That means parents company's equity are the remaining. This is the parents company's equity. So this is only for P. This is only for parents company's equity. Okay. So we fulfill this requirement: asset equal liabilities plus equity. And we close. And this is the liabilities and owner's equity for. So asset equal, you can see that liability plus owner's equity. The total asset equal liabilities and the owner's equity. So let's talk about another question. So question 1B. So another case. You acquire 90% of this company, not 100%. And this is your payment. You paid $140,000. So this is the journal. So this is the case 2 journal entry. $144,000 you paid. Your investment. This is your investment, $144,000. Now we are going to apply 3 steps. We are going to apply 3 steps whether we have any difference or not. So we already know from this question, we know we should have a non-controlling interest, right? Do you understand? If it is less than 100%, you must have non-controlling interest. You have to establish it. I will show you very soon. And we are going to apply 3 steps. Price paid. We paid $144,000. Percentage acquired. Percentage acquired 100%. So based on this 2 information, we are going to calculate implied value. And what is the implied value here? If you use your calculator, implied value is here 160,000, right? 160,000 is the implied value. So then we have to compare implied value and book value. So this question do not give you net asset. This question give you these 3 items of subsidiary. Common stock, additional paid-in capital, and returning. So this is the book value. So if we add these 3, also 160. Again, implied value and book value is similar, right? Implied value and book value is similar. We don't have any difference. We don't have any difference. But what is the difference between case A and B? What is the difference between case A and B? So if we have less than 100%, we must establish non-controlling interest. Okay, we must establish non-controlling interest. So we are going to see what is the percentage goes to parents company. You can see the parents company will get 90%. And what about the subsidiary what about the non-controlling interest? Non-controlling interest is remaining 10%. So parents company acquire 90%, 10% is the non-controlling interest. So if you have non-controlling interest, then we have to calculate. We have to calculate. In short, it is called CAD schedule. CAD schedule. That means we are going to compute and allocate differences between implied value and book value for parent company and the non-controlling interest. So these are the additional things you have to do. These are the additional schedule you have to do if there is any non-controlling interest. So this is NCI. This is NCI. This is NCI. This column is the NCI because we have to establish. We have to establish our NCI. Then you know that this is the total. This is the total value of the company, implied value. This is the total value of the company. So we are going to compare. You know that we are going to compare implied value. We know these 2 information. We know what is the implied value. We know what is the book value. We know this information. For example, I delete this. We know implied value and we know the book value, right? So this is the implied value of subsidiary. This is the implied value of S. This is the implied value of S, right? And this is the book value of S. This is the book value of S company, subsidiary company. So, but you cannot claim as a parent company, you cannot claim 100%, right? Why you cannot claim 100%? Because you acquired only 90%. So my mistake. It is 90%. 90%. Okay, this was my mistake. So you can correct it. So This is the implied value of subsidiary company, and this is the book value of subsidiary company. But you cannot claim them 100%. Although you consolidate, can you remember? Although we consolidate 100% of their asset here. Also, we consolidate 100% of their asset, 100% of their liability, right? Can you remember? Even you purchase less than 100%, you have to consolidate 100%. So although you are going to consolidate 100% of their asset and liability here, although you are going to consolidate 100% of asset and liability, but you cannot claim that you are the owner of 90%, right? So owner of 100%. So 90% goes to the parent company and remaining 10% goes to the subsidiary company. So total implied value is $160,000. This is the total implied value, $160,000. So 90% will go to the parent company and 10% is the non-controlling interest, right? So it is $144,000. $144,000 is the parent company 90%, and remaining $16,000. Remaining $16,000 is the non-controlling interest. Do you understand? This is the total implied value, right? The total implied market price. You can only claim 90% because it is your investment, and remaining 10% is the non-controlling. So we have three book values. Look, we have three book values. It is three. We have three book values under subsidiary. And this is the book value of subsidiary company. So this is the book value of subsidiary company, but as a parent company, you can claim only 90,000. This is 10,000. 18,000. This is 2,000. 36,000 and 4,000. So we allocate implied value based on their percentage. We allocate book value based on their percentage, or is the total. So you can see the total book value. If we add these three, total book value is $144,000. And the total book value for NCI, it is $16,000. Now we see that implied value 160, book value also 160. In case of parent, you can see that 144 implied value, book value 144, non-controlling interest the same. So difference is 0. Difference is 0. So again, this question is easy. Why this question is easy? Because we don't have any difference here. We don't have any difference, but if we have difference, we have to eliminate the difference and allocate this to some place, either asset or liability. So again, this is easy question. This is easy question. So case 1, we did not have any NCI. Case 2 we have. So this is the case 2. Implied value equal book value, right? Acquire only 90%. So remaining NCI, we established NCI 10%. So if you have NCI, you have to prepare the CAD schedule. Now we prepare the consolidated balance sheet here. Now we are here. We are going to prepare the consolidated balance sheet. So when we prepare the consolidated balance sheet, we have to eliminate something and we have to establish something, right? So we have to establish, look at here, we have to establish an NCI, non-controlling interest. New item came here, NCI. New item came here. NCI, then we are going to solve this. Again, I suggest you to solve this question by applying the journal entries. Yes, I can copy this from here, because here we have non-controlling interest, right? So if we have non-controlling interest, we have some journal entries. So this is case B. What kind of journal entries we can expect? So as we don't have any difference here, but we have non-controlling interest, right? We have non-controlling interest. So here, our investment is $144,000. We credit it $144,000 to eliminate. We're going to eliminate this 3. And we find that we have NCI, non-controlling interest, which we credit $16,000. Why it is credit? Because you can see that the non-controlling interest should go under the equity section of parents company, and equity means it is credit, right? Equity means it is credit. So now this is debit. We can put in the debit side of the elimination entry. Debit. We put this amount in the credit. I mean investment in subsidiary credit. It is closed, right? We close equity account of subsidiary. We close investment in subsidiary, and we establish NCI. It is credit side. So these things came from the journal entry. You can see that. This is the elimination column. We eliminate this 2, and we establish our NCI, right? We establish our NCI. Then after closing this, very simple, we're going to record this $96,000. So here we have to think this way: asset equal liabilities plus equity. We have to apply this. Now total asset is $916,000. And here this is although you don't need to write it in the exam, but for your reference, I always write this. You no need to tell me P plus S. Okay, in the exam, it's not mandatory. So I put here P plus S to show you why we delete this, right? And the liabilities, 220,000. Yes. So we already record subsidiaries asset. We already record subsidiary liability. So we don't need to keep this again. So we close it. Then this $16,000 will go under the equity section of parents company, right? And we have these 3 parents company's equity we put here. So this is for P. and we established NCI. We established NCI. So this is the first case. So what is the first case about? Go here. Case 1. We implied value equal book value, right? Implied value equal book value, we acquire 100%. Then what is the case 2? Implied value equal book value, we acquire 90%, and remaining 10% we establish non-controlling interest. Then we have, can you remember? We have another situation. What are the another situations? These are the another situations. So we already done only this part. Implied value equal book value, no difference, right? And 100% acquire or less than 100%. Now next class, I will explain case 2 and case 3 together. Like implied value is greater than the book value, we have a difference, right? And implied value lower than the book value, we have a difference. So difference may be debit, difference may be credit, based on which one is higher. Then we may have 100% acquire, or we may have less than 100%, we may have NCI. And if we have a difference, how to allocate this difference? Okay, because step 3 said that if you have any difference, we must allocate. Look, we must allocate. We must allocate and adjust where? Either asset of subsidiary or the liability of subsidiary based on the question. Okay, I think that's all for today.